in today's jobs report, we were looking for something that decisively said we are not going into a recession, that the recent rise in the unemployment rate was a fluke, the jobs market is actually doing okay. Well, we did not get that today. Not at all. Like, not even close. In fact, today's jobs report just solidified those fears even more for investors, and there's going to be some rough times ahead for equities. And I'm just going to lay it all out there for you. The bull case, the bear case, what the bull and bear argument is heading into the Fed meeting on September 18th, and what I'm expecting out of Tesla stock as well. Tesla stock is in its own pretty interesting category because it does have a major event coming on October 10th with the Robotaxi event. And honestly, September, is important. Historically, it's a pretty weak month for stocks. In fact, the worst month for stocks. And it looks like we're living up to that again. But October during election years is even worse than September. So I do recommend you guys share this video. Share this video with someone you think needs to hear it. Not if they're just Tesla stock investors, but if they're investors in our markets, period. This information is really dual purpose. If you're in Tesla, great, you're going to benefit from this. If you're not in Tesla, great, you're going to benefit from this information. And I think we should start with today's jobs report. And really, as I mentioned, we were looking for something decisively good. We were looking for 165,000 job ads. Well, that didn't happen. We came in at 140-some thousand job ads. Not good. Because if you consider these numbers are probably false to begin with, you're probably going to get another big revision for this month, coming next month. The jobs number is actually much worse than 165,000 jobs. Okay, fine. The unemployment rate, it actually was expected to go down about 0.1%. It only went down about 0.33%. So it only went down 0.03%, which is like marginal, which is just a rounding error, if you will. So we did not get a, good report today. Not from the market's perspective of what we were pricing in. And that is why stocks, after initially moving higher upon this jobs report, actually tanked because everyone realized this was actually not a good report. You are continuing to see full-time jobs being vanished, disappearing, whereas part-time jobs is really what is giving us the job creation to begin with. So when you net full-time jobs versus part-time jobs, you're still in a worse off situation now than we were last month. Think about it like this. If you're, let's say, losing 500,000 full-time jobs, but you're adding 600,000 part-time jobs, yeah, sure, you might have 100,000 net positive job creation, but you're actually like way negative on hours worked, on what disposable income will be created there, and really purchasing power in the economy. And this is basically what's happening right now, is part-time employment is going higher as people look for and find second jobs, and full-time employment is vanishing. We're down 1 million full-time jobs in August of 2024 compared to August of 2023. In August of 2023, there was 143 million full-time jobs. Now there's 133 million part-time jobs, so 1 million less. It's not good. So from the perspective of investors hoping for a really good jobs report to set aside some of those recession fears, some of those slowdown fears, that did not happen. And that is very important heading into the first Fed rate cut, because now markets are pricing in about a 65% chance of a 50 basis point cut following Fed Waller's comments today, suggesting he would be open to front-loading rate cuts, kind of like what they did in 2022 when they gave us those 75 basis point hikes back to back 3 times in a row. He says, well, front-loading some rate cuts would also make sense if the economic data warrants it. And there's a lot of institutional investors on Wall Street that are starting to say, one, a 50 basis point cut is not going to be good for stocks, that's probably going to cause more panic than anything else. But also, no matter if we get a 25 or 50 basis point cut, that you should actually sell the first Fed rate cut. That's the narrative being talked about on Wall Street right now. And normally, I should add, that's what tends to happen. You tend to see the markets sell the first Fed rate cut. That's because usually the Fed is cutting into a slowing economy, and that's typically not good for markets. We also have the 2 and 10-year yield curve inversion that is now uninverted about 3 basis points, which 3 basis points, that can come, that can go. But if we stay inverted, it's a pretty clear sign that we could be heading into a recession soon. Usually when you get that 2 and 10-year uninversion is when you're right about to enter a recession. I know a lot of people talked about this in 2022 and 2023, like the yield curve's inverted. Oh my gosh, that's so bad for markets. No, it's not. The actual inversion is actually positive for stocks. When you go, positive, when you actually uninvert, that's when this number here goes positive. That's when you are usually a couple of months away from a recession. And I think this is hitting the algorithms today. It is causing some additional selling in markets. But I think where we are now is really not in a good place. Because this jobs report was not decisively positive, it was more negative than positive. Sure, there were some aspects of positivity within this report, like the breadth of job creation. Although it was small, it did get a little bit better, with leisure and hospitality at the top of the list. Social assistance and healthcare second up. You actually had construction jobs that added jobs last month. Manufacturing was negative. Mining and lodging came in at 0. A couple other sectors came in negative. But for the most part, there was a larger breadth of job creation, although it was on a small scale. But honestly, if you look at leisure and hospitality, that would be like restaurants, hotels, right? I've been in this industry my entire life, and you're not seeing good things right now for leisure and hospitality, okay? People are starting to get fired. They're starting to get laid off at the bare minimum. And that's a trend that is going to continue over the next couple of months. This just adds more confidence to my thinking that the jobs report is severely lagged behind. Like, these August jobs are really like June jobs, in my opinion. That's kind of it's representing where the economy was in like June, in my personal opinion. So once we get to like December and we're actually seeing like August, September jobs, you're going to see a much different picture. Leisure and hospitality is going to be pretty weak. Construction even is probably going to be on the weaker side. You did see manufacturing that lost 24,000 jobs, and that is also probably an area of fear as well today in markets, because when you see that kind of decline in manufacturing, that's usually not a good sign. But really, when I want to boil all of this down to is September seasonally tends to be a weak month. The only data that could have saved us in terms of, cause markets to go higher was just a standout positive jobs report. Unemployment rate that decisively fell lower, proving that just weather was, affecting that, and a strong payroll number. That did not happen. Yes, you marginally moved down on the unemployment rate again, but that was marginal. You missed on the job creation number, and, well, it was just not positive, okay, for other reasons as well, but I don't want to focus on that too long. So September already tends to be a really bad month. And you're already, following that, right? You've already started to see September was a bad month. We had, what was it, the 5th worst first day of September trading in the history of the markets? Yeah, we needed something decisively positive today. We did not get that. The talk again on Wall Street is you should sell the first Fed rate cut on September 18th. That's normally what happens. That's not good. And there's nothing to really stop that at this point. October during election years tends to be worse than September. So September minus an election tends to be the worst month of the year. October during election years tends to be the worst month of the year. And I think part of the problem with markets here is we're trading based on the Fed, we're trading on economic activity, we're trading on the first cut from the Fed, but we're not even trading around election risk yet. And just the pure election uncertainty tends to give you close to a correction in the S&P 500. What happens when we start to price in some of this election uncertainty? Let's be honest. Trump's policies of 10% or more tariffs, that's not necessarily good for economic activity in the near term. Kamala Harris, right? That's obviously not good. Taxing unrealized gains. It could prompt more risk-taking behavior because if you can, get taxed on unrealized gains, you can also write off your unrealized losses. So you probably see more risk-taking behavior, but raising the corporate tax rate, that's not good. So both parties really have factors that could be negative for equity markets if we just want to, stay as apolitical as possible, as unbiased as possible. We really don't have a clear economic winner, at least from the market's perspective, in the very near term. It's just not going to be good, right? So I think you will get election uncertainties and risk in October. Add that to September's issues, and I'm not very optimistic here. Now, you can also add to this that earnings expectations are still at all-time highs for 2025. We're heading into a weakening economy as the markets start to say, hey, how's a 10% tariff on everything going to affect economic activity? How is taxing unrealized gains going to affect the stock market and the economy and homeowners and the like? You need to bring down earnings estimates. That's a fact. From now until the end of this year. As markets are now in September, we're looking forward to 2025. And from that perspective, there's nothing really positive going for markets here unless we get surprises to the upside on economic data. And we really don't have too much economic data from now until September 18th. We've gotten a lot of economic data recently. We do have CPI and a couple of other things, but the jobs report was really the big one for September. And it just didn't do anything for us. So from the aspect of September seasonally sucks, the jobs report was bad, Wall Street's saying you should sell the first Fed rate cut, especially if it's a 50 basis point rate cut. From the prospects of October being a really bad month during election years and pricing in some of that, election risk, right? And what that could ultimately mean for the economy, and earnings estimates being at all-time highs, needing to come down into the end of this year. There's a handful or two reasons why stocks are going to go lower from now until the end of this year. I can think of one reason why stocks would go higher from now until the end of this year. Earnings estimates, they're not going higher. Okay. And you can even add to the bearish argument, what if Q3 earnings disappoint or start to disappoint in a larger way? Yeah, that's also not going to be good. But the only real bullish argument that I have for you is the economy somehow surprises to the upside. And Wall Street does not sell the first Fed cut, which looks like kind of what we're seeing now. I'm not confident in that. I think the data is so lagged behind that what we're actually seeing in the economy now is worse than what it was, 3 or 6 months ago. Some of the data were being reported. So in other words, over the next couple of months, you're just going to see the data get worse. That's my personal opinion. So I don't really think we're going to get an upward surprise to economic data. And from that perspective, I don't think there's much of anything to be bullish on right now from, really today until the end of this year. Now, some areas of the markets can do better than others, like high-paying dividend stocks, like a CVS, for an example. That's actually green today, at least last I checked, that pays 4.5% dividend, safe dividend, as now 10-year treasury yields are 3.6%. that starts to look more attractive for anyone looking to seek out yield. And presumably the stock of CVS may go up and the yield may go down, especially as the Fed does actually start to cut rates and those money market yields do start to fall. So I think that area can do well. I do think certain stocks like Tesla have the potential to do well. If the robotaxi event is like, jaw-dropping, if we actually get a flawless event with the first, let's call it paid robotaxi event, maybe it's Elon himself that goes on the robotaxi event and pays Tesla. The legality of that, who knows? But that's where I could see an upside surprise for Tesla. But I wouldn't be confident in that. I'm not confident in, markets generally speaking moving higher. Can Tesla move higher? Well, it depends on the robotaxi event. I'm not expecting much of anything now for September because I do think the markets will sell the first Fed cut. I mean, you might go up for a day or two, but then you're going to come right back down, in my personal opinion, because the Fed is cutting into weakness. And the data is just going to get weaker from here, in my personal opinion. So honestly, I struggle with the bull case here. Yes, you can look at, history and, strong first half of the year tends to lead to a strong second half of the year, blah, blah, blah. But none of that's a certainty. None of that, should be used as kind of a barometer of how you should invest your money. And beyond any upside surprises to economic activity, I'm just not confident here at all. I'm not excited here at all. If there was like a bull bear scale, I know like a Meet Kevin talks about this, but let's say 0 is like super bearish and 10 is super bullish. I'm at like a 1.5 from now until the end of this year. There's really not anything that's going to give us that upside surprise, especially with the election and with the trajectory of economic data. I don't like the setup that we're heading into. Now, 2025, post-election, I do think we can see a rally, especially if I'm wrong and the economic data starts to come in strong. Now, do we see a post-market rally just based on the election itself? Probably. It'll probably be short-term lived in nature, unless we see the economic data follow through, which, I don't know if that's going to happen, but from my perspective now, it doesn't look likely. So I think 2025, whether or not 2025 is a good year or not, really comes down to the economy. It comes down to economic data and earnings estimates. Earnings estimates drive stocks higher or lower. If you want to cut through all the noise here, earnings estimates drive stocks higher or lower in the medium term. Well, earnings estimates are far too high. Adam Parker on CNBC runs Trivariate Research. He's a momentum investor. That's why he's bearish right now. And he's been super bullish, like nauseously bullish over the past 12 months. Rightfully so, I will say that, on markets because, earnings have come in good and AI and all these things. But now he's saying, well, he's not that excited about stocks. He's actually pretty nervous about stocks because heading into the end of this year, we're going to have to, bring down those earnings estimates for 2025, especially as the economy weakens. And if those earnings estimates hold up and they don't fall, then we can see some multiple expansion, maybe. That's your upside surprise in 2025. If the economy holds up in early 2025, let's say in Q1, then you also see small cap cyclicals, Tesla, dividends and value outperform. I think in that environment, you would see big tech underperform. That's the bull case for 2025, for Q1 2025. But until we get there, really the rest of this year, at least until the election, and then maybe a small rally after the election, there's not really anything to be excited about, in my personal opinion. Let me know where you guys are at on the bull bear, scale, 0 being super bearish, all in cash, and 10 being super bullish. Like a 1.5. Like, it is really bad. And maybe I'm missing something. I try to stay balanced in my approach. Like one area, for an example, if the Fed does cut rates and it does boost home transactions, I do think that's a source of a lot of equity, a lot of money that could be spent. If people are able to sell their homes and buy a new home, they're going to have hundreds of thousands of dollars in the bank and able to start spending on things again. I think that is an upside surprise to economic activity. But if people are losing their jobs, then how good is that ultimately going to be? So I do think 2025 can have some upside surprises, like if home transactions start to actually pick up, home sales start to pick up. But the rest of this year just does not look good. Now, for Tesla stock specifically, Tesla is down over 6% today. It looks like you did at some points hold support around this 216 level, this trend line. You want to see that hold support. I don't really care what happens throughout the rest of the day today. I really want to see what next week has in store for Tesla. If you hold this trend line, then it's possible that we could rally. But I think the market dynamics, the market forces are just going to be so strong on Tesla. This negative September, what's going to be a negative October as well, where it's probably going to hold Tesla around this area. I wouldn't be surprised heading into the event itself, like the week before, Tesla could outperform a little bit, potentially rally, but that's not my base case assumption right now. My base case assumption is anywhere from like 200 to 220 heading into that event. And then what that event gives us could spark a much larger rally. But I was really hoping for the Tesla bulls that today's jobs report was going to be a good one, because Tesla would have had a very, very strong rally into the robo-taxi event. Now, for anyone that wants to know kind of how I'm trading this market, how I'm proceeding next in this market, cash is king. Let's be honest. If you have stocks that are near all-time highs still, Apple, Amazon, Microsoft, those would be the areas that I would be selling right now, that I would be trimming and raising as much cash as possible. Because, I mean, if we don't go into a recession, if we avoid a recession, those areas are not going to outperform, right? The areas that will outperform are Tesla, value, dividends, small caps, cyclicals, basically everything else besides big tech. I think some of the AI momentum has definitely slowed way down. And that was specifically what was helping drive a lot of those stocks higher. So I think cash is king, selling, reducing positions in stocks that are at all-time highs that you don't think offer a great risk to reward or upside if the Fed actually does achieve a soft landing would be prime areas to take some profits. I also think some hedges over the next 45 to 100 days or so make a lot of sense here. I would probably wait for a green day to honestly get a hedge or two. But I think that also makes sense if you know how to trade, if you are an active trader. If you guys want to come trade with us, check out that link down below in the description of this video. Definitely have some hedges on now. Plan to do a little bit more hedging if this does turn into a bigger downward event. And the problem is really on a technical basis for the S&P. You filled the gap today and you're closing under the gap, right? Under the gap fill level by quite a margin. And there is a lot of room to fall here. Your 100-day moving average at 536. Next up, you have your this support line here at about 520. That could very well be the level that we hit in the month of September. Could be this 520 area. Then from there, it's your 200-day moving average at about 511. Do we hold support there or do we fall through there? And to be honest, I think we could be approaching the 490 to 475 level by the end of this year, if not worse than that. If the economy does actually start to take a turn for the worse. So I think there is still a lot of time here to raise cash and hedge out portfolios. Not a lot of time, but you have a little bit of time still where stocks are still elevated. We haven't fallen much. Hedges aren't too expensive, and to actually make it make sense. So I don't know, my thoughts in just one long spiel. Let me know what you think down below in the comment section. You guys have a fantastic rest of your day and weekends. I will see you in the next one.